Hey, welcome back. So in our last video, we talked about what options are. And if you haven't seen that one yet, go check it out first. The link is right up there. But today we're going to go even deeper. We're going to talk about the two types of options, the call and the put, and I'm going to explain both of them in the simplest way possible. In fact, I'm going to explain it so simply that even a kid could understand it. Let's go. First, let's use a simple story. Imagine you're at a lemonade stand. A cup of lemonade costs $2 today, but your friend tells you, hey, I think the price of lemonade is going up next week to $5. So you make a deal with the lemonade stand owner. You say, I'll pay you 25 cents right now just to lock in the right to buy lemonade at $2, even if the price goes up later. The owner agrees. That 25 cents you paid, that's your premium. The $2 price you locked in, that's your strike price. And the deal you made, that's your option contract. Now, depending on which way you think the price is going to move, you're going to use one of two options, a call or a put. Let's break them both down. The call option, betting the price goes up. A call option is what you use when you think a stock's price is going to go up. Going back to our lemonade story, you locked in the right to buy lemonade at $2. If the price jumps to $5 next week, you can still buy it at $2 and save $3. That's a call option. You called the price up. You win when the stock rises. Now let's use a real stock example. Let's say Apple stock is trading at $200 today. You think Apple is about to release a huge new product and the price is going to jump. So you buy a call option with a strike price of $210, expiring in 30 days. You pay a premium of $5 to own that contract. Remember, one contract equals 100 shares, so your total cost is $5 times 100 equals $500. Now let's look at what happens from here. The upside of a call option. If Apple jumps to $230 before your expiration date, you can buy those shares at $210 and immediately they're worth $230. That's a $20 gain per share. Times 100 shares, that's $2,000 in profit minus your $500 premium, leaving you with $1,500 investment. That's the power of a call option. The upside is huge. Theoretically, the stock could keep climbing and your profits keep growing with it. The downside of a call option. Now here's the honest truth. If Apple never reaches $210 before that expiration date, your option expires worthless. You lose your $500 premium. That's it. Gone. That's the downside of a call. If the stock doesn't move the way you expected, you lose what you paid up front. Nothing more, nothing less. So the most you can ever lose on a call option is the premium you paid. The put option, betting the price goes down. Now let's flip it around. A put option is what you use when you think a stock's price is going to go down. Back to our lemonade story. Imagine instead of thinking the price is going up, you think the lemonade stand is about to have a bad week. Maybe it's going to rain all week and nobody wants lemonade. So you make a different deal. You pay 25 cents for the right to sell your lemonade back at $2, even if the price drops to 50 cents. If the price crashes to 50 cents and you can still sell at $2, you just made a profit. That's a put option. You profit when the price drops. Let's use Apple again. Apple is at $200, but this time you think the price is about to drop. Maybe they had a bad earnings report coming up. So you buy a put option with a strike price of $190 expiring in 30 days. You pay a premium of $5. Again, that's $500 total for one contract. The upside of a put option. If Apple drops to $160, you still have the right to sell at $190. That's a $30 gain per share, times 100 shares. That's $3,000 in profit, minus your $500 premium, leaving you with $2,500. A put option lets you make money even when the market is falling. That's a powerful tool to have in your toolbox. The downside of a put option. Same story as the call. If Apple never drops below $190 before your expiration date, your put option expires worthless. You lose your $500 premium. The stock went up instead of down. Your bet was wrong. And just like the call, the most you can ever lose is what you paid up front. Side-by-side comparison. Let's make this crystal clear. Let me put both of these side by side so it really sticks. A call option. You think the price is going up. You profit when the stock rises. Your upside is unlimited. Your downside is limited to the premium you paid. A put option. You think the price is going down. You profit when the stock falls. Your upside is very large, limited only by how far the stock can drop. Your downside is limited to the premium you paid. Here's the beautiful thing about both of them. As a buyer, you can never lose more than what you paid up front. That's built-in protection. The simple way to remember it. Here's a trick to never forget the difference. Call. Think of calling someone up on the phone. The price goes up. Put. Think of putting something down on a table. The price goes down. Call equals up. Put equals down. That's it. Quick recap. All right, let's bring it all home. A call option gives you the right to buy a stock at a set price. You use it when you think the price is going up. Your potential profit is huge. Your max loss is your premium. A put option gives you the right to sell a stock at a set price. You use it when you think the price is going down. Your potential profit is very large. Your max loss is your premium. Both options expire on a set date. Both cost a premium upfront. And with both, the most you can ever lose as a buyer is that premium. Now you know the difference between a call and a put. And honestly, you already understand options better than most people out there. In our next video, we're going to talk about how traders actually use these options to generate consistent monthly income without having to predict the market perfectly every time. If that sounds interesting, make sure you're subscribed and hit that notification bell so you don't miss it. Drop a comment below. Which one makes more sense to you right now? The call or the put? I read every single comment. I'll see you in the next one. Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. I appreciate you watching. Seriously, I'm Covered Wings and my mission is simple: to help you let your money fly. Subscribe and I'll see you in the next one.